Before we start tonight, there's a video of next week's class that will be posted to Engage. We're not meeting on Memorial Day. Okay. Now, what this means, unfortunately, is that you all have to do the go live. Okay. Now, with the lecture I gave, the go live problem should not be that difficult. Okay, so just a heads up on that. Okay, now last week, in terms of the accounting cycle, we talked about accounts, we talked about journal entries, and posting to the ledger. And then the last thing we did in the go live was to prepare a trial balance. All right, now tonight we'll talk briefly about adjusting entries, and we're going to talk about the 3 of the 4 required financial statements. Okay, now for the go live, you're going to take an adjusted trial balance and prepare the income statement, the statement of stockholders' equity, and the balance sheet. All right, and my purpose here is to enable you to do that sometime before tomorrow at sunup. Okay, and then we'll talk about closing, which I kind of referred to. And then the last step is preparing the after closing trial balance. Okay. Now, oh, I wish I could blow this up. All right. This is a trial balance. All right. Now, if some of you have your books, this is very important. I know that as an instructor, we never want to just teach the quiz, if you will. But I said last week that a trial balance is simply a dump of the ledger. And I said the ledger was prepared assets first, then liabilities, then equity, and then revenue and expenses. So if I'm, tonight you're going to start with a trial balance. All right. If some of you have peeked at the go live, there's a trial balance in it. And I'm telling you that the first thing you do is prepare the income statement, and everything from revenue down belongs on the income statement. And we'll give examples of that. Then you do the statement of stockholders' equity, and then you do the balance sheet. But the trial balance is like a menu, all right? And it's not organized alphabetically by height. It's organized by assets first, then liabilities, then equity, then revenue, then expenses. So when you prepare the income statement, you don't have to guess what belongs. You simply pull off the revenue, subtract the expenses, then you do the statement of stockholders' equity, and then you do the balance sheet. Okay. Now, could you pull up the Excel spreadsheet? Okay. Now I'm going to put this up in Engage. Okay. And what I want you to focus on is the top line up here. Now, last week I said that under the umbrella of stockholders' equity, there's a lot of stuff going on. Okay. Stockholders' equity contains both common stock and retained earnings and dividends. But during the year, revenue and expense fall under the umbrella of stockholders' equity. Okay, is everybody? I'll let you take a minute. All right, everybody absorbing this? All right. Now, the reason revenue and expense are under the umbrella of stockholders' equity is that people begin corporations because they want to earn a profit. So the profit belongs to the owners, okay? But during the year, we keep track of the revenue and the expense, and we arrive at net income. So in a few minutes, I'm going to say the first statement that we prepare is the income statement. Now, this is an equality. Assets have to equal liabilities plus stockholders' equity. If I break the equality by pulling out revenue and expense, how do I fix it? Right? I've just broken the equality. All right? Is everybody grasp that? Okay. So what bridges the income statement and the balance sheet, because at the end of the day, the balance sheet has to balance, is the statement of stockholders' equity. All right? In other words, there's an intermediate step. To get the balance sheet to balance, after I do my income statement, I do the statement of stockholders' equity. And that gives me the number that will allow me then to prepare a balanced balance sheet. Okay? All right. Now, anyway, I will put this up in Gauge, and then later on, when we talk about the statement of cash flows, we'll reuse it. Okay. All right. Can we go back to this? All right. Now, the other thing I want to talk about, somebody mentioned adjustments. Okay. Last week we talked about accrual accounting, and we said we're going to recognize revenues when they're earned and expenses when they're incurred. Part of accrual accounting is, all right, so for accrual accounting, we create receivables and we create payables, okay? All right, and that's where we stopped last week. We talked about recognizing revenue we sell on account, but people don't pay us until later on. But we recognize the revenue at the time of the sale, and then if I incur expenses but don't pay for them, that creates payables. All right, now, under the umbrella of accrual accounting is called deferrals. And deferral simply means that we're going to postpone, we're going to receive cash or pay cash and defer the recognition of expense or income. Okay, now what the heck do I mean by that? I buy supplies. Maybe in your own businesses, do you have gatekeepers, or do you let the office supply room just open to anybody that wants to go in? No, you have a gatekeeper, right? So when you buy the supplies, you record them as an asset, and then at the end of the year, you count what's left and expense what's not there, okay? I used to work for Niagara Mohawk, and in between Thanksgiving and Christmas, Scotch tape suddenly disappeared. Who knew? Okay, all right. Many of you might do this. Maybe you sell insurance. It's not uncommon for businesses to want to lock into a premium. So they buy a 3-year policy. Would it be appropriate to expense 3 years of insurance in 1 month, the month you pay for it? No. What people do is they pay for the expense, and this is one of the questions in Connect, so I buy a 3-year policy, and what I'm going to do is I'm going to expense $1,000 a year. Okay, and what companies really do is they probably expense it monthly. Okay, all right. Many of us, I'm sure, have engaged the services of a contractor. New roof, addition, redo the kitchen, redo the bathroom. And what do they want? They want a deposit. Okay, why? Because they want to lock you in. They don't want you to sign the contract in April, and then in July you say, nah, I don't want to do it. But if they ask for 30% down, you're more likely to not change your mind, okay? Well, when they get the deposit from you, it's cash. I'm not arguing that, but it's not revenue until they come out and they do your roof or redo the kitchen. That's unearned revenue, deferred revenue. I'm getting the cash, but I'm deferring the recognition of revenue until I actually perform the service. Okay? So, I told you that the original purpose of the trial balance in the days of manual accounting is to make sure that debits equal to credits. Now, as a practitioner, I get a hold of a client's trial balance and I want to know, well, is this shop supplies, is that at the beginning of the year or have you adjusted it for the end of the year? If I see unearned revenue, my question is, well, have you earned any of this? Okay, or if I see prepaid insurance, has any of this insurance expired? Okay, all right, so we use it as a tool to determine what work we need to do. Now, again, I went through the homework on Connect, and the only thing they ask you to do is to write off some insurance to expense. Okay, but those are adjustments. All right, now I realize this is quick and dirty, but again, we're not trying to make accountants out of you, but that's what adjustments are. Okay? Okay, so, but again, tonight when you're in your breakout sessions, you're going to be provided a trial balance. The first thing you do is the income statement, then you do the statement of stockholders' equity, and then the balance sheet. So let's see what these things look like. Okay, any questions? Yes.
This is accrual, but are there any businesses today that actually still do cash basis?
Yes, cash basis is acceptable for tax preparation.
And what would be the benefit of?
Well, you can play games with cash basis. All right, because it's acceptable for doing your tax returns. So you're a contractor. You completed a big job. You're not preparing financial statements. You're not worried about GAAP. So your customers getting ready to write the check. All right, now to this customer paying paying you for the work on December 28th or January 2nd, they're indifferent. Okay, all right. So you say, well, wait a minute, pay me next year.
Right.
You can play games with cash basis. There's nothing illegal about it. But what the government does is says if you're above a certain amount of income, then you have to be accrual. All right.
What is that threshold?
Oh God, you would ask. I don't know. I don't. It's a 3-year average.
Okay.
I think it's like 10 million. I don't know everything. I try to act like I do. Okay. All right. So let's go through the statements then. The first statement, and that's what the slide says. The income statement is prepared first because it determines the amount of net income which will be used to update retained earnings. Okay. Now it's called various things: income statement, earnings statement, statement of operations, profit and loss. Okay, and really look at the income statement like it's a scorecard. All right. And again, I said accounting revenue, expense, and dividends are closed to retained earnings every 12 months. Okay. The accounting year is 12 consecutive months. But for the year, I want to know how I'm doing, okay? Now, one of the problems with accounting is that we have to make estimates. when we calculate depreciation on a fixed asset, we estimate the life of the asset, we estimate salvage value. Maybe some of you are familiar with the allowance for doubtful accounts, where you have thousands of customers, each owing you a little bit of money. So, some of them are going to go bad. You just don't know which ones. So you estimate that debt expense. If you offer warranties to your customers, generally accepted accounting principle says you have to estimate what your warranty claims are going to be. So there are estimates involved in the preparation of the income statement. Okay. Which we even have a footnote in our financial statements that says some of the numbers are based on estimates, and if the estimates prove to be wrong, it could have a material effect on the income statement, or on the statements as a whole. All right, now again, these values are being taken from that trial balance. And this is called the single-step income statement. You list all revenue, subtract all expenses to arrive at net income. Okay? But again, don't get twisted up in your togas here, folks. You look at the trial balance, everything from revenue down belongs on the income statement. Okay? And it was done that way on purpose. Okay? The reason the ledger was put together the way it was is to facilitate the preparation of financial statements. All right, now, again, I said the intermediate step then is the statement of retained earnings. Okay? Because when you look at a trial balance, the balance that says of retained earnings is last year's ending balance, because we haven't closed this year's activity yet. So if you were to look at a trial balance and you see retained earnings, you say, oh, okay, I'm done. No, you're not. That retained earnings balance is last year's ending balance. So what I have to do then is I have to update what retained earnings should be. Okay? And here's how we do it. It's last year's ending balance, which is this year's beginning balance, plus net income minus any dividends that have been paid. Okay? All right, everybody? Okay, hold on a second.
Wasn't there, in this example that you just had up there, the retained earnings, was just for that one period. What if there was a carryover balance of retained earnings?
Well, that's what you're updating. In other words, the balance on the trial balance is going to be the beginning balance.
Oh, okay. I didn't know they were showing it as zero.
Well, that's because it was a startup.
Okay.
Okay. All right. Okay, so the intermediate step then is the statement of retained earnings. And again, very simple. Tonight you're going to calculate the value of net income, revenue minus expenses. Then you're going to subtract any dividends that were paid right off the trial balance. And now I have what my ending balance of retained earnings should be. Okay? And now I can balance my balance sheet. Okay? So the balance sheet lists assets in the order of liquidity, and then the claims on those assets. All right? And the claims are either by creditors or the owners. Okay? Now, the balance sheet is the only financial statement that's as of a date. Okay, so if you look at, if you're doing your project, you're going to see the balance sheet is as of December 31st, 2016. All right? Now, why? Well, on January 2nd, the mail's going to come in. You're going to get checks from customers, which is going to affect cash and accounts receivable. You're going to get vendors' invoices, which is going to affect expenses, and accounts payable. The whole, you're gonna send out bills to customers. So the whole dynamic is going to change the next business day. So the balance sheet is the only financial statement that's as of a date. It's like a one-day pass the beaches. Okay. Right, and again, this is, the balance sheet is listed in the order of liquidity, cash obviously being your most liquid asset. And tonight, before we leave, we're going to talk about a classified balance sheet. And then liabilities are listed. Usually you could throw a dime over current liabilities because they're all due within 30 days. Okay. And then the retained earnings number that we calculated makes our balance sheet balance. Okay? So again, income statement, statement of retained earnings, and then the balance sheet. Okay? All right, any questions?
Can you just explain the accumulated depreciation?
Oh, we haven't done the fixed asset chapter, and I don't even know if we're going to, but remember I talked about deferring expense, and I said prepaid insurance and prepaid rent? Okay, well, the biggest prepayment is when I go out and I buy long-lived assets. Okay? What do I mean by that? You buy a vehicle, you buy a piece of machinery, and you're purchasing that in order to generate a revenue stream for years to come. All right? So you don't expense this on the day you buy it. You put it on the balance sheet as an asset, and then over its useful life, and useful life here means that the time where I can use it to generate revenue. Okay, useful. All right, it's helping me generate revenue. And generally accepted accounting principle says that you take the cost of this asset, put it on the income statement as depreciation expense, and then credit this contra asset account called accumulated depreciation. Okay, now, the reason we show both the cost and the accumulated depreciation is because it helps the financial analyst compare old companies to new companies.
But in the column here, if there was the $12,000 was tools and equipment, so less accumulated depreciation. So in the first year, if you're doing this over like a 5-year period, wouldn't the first year it would only be a fifth of it? So then,
well, yeah,
right?
It would be, yeah.
Okay, all right.
Yeah.
And then so the right column would actually be what's left.
This is called book value. And depreciation was not meant to be a surrogate for market value. We buy the asset, we estimate the life, we estimate salvage value if there is any, and that's how we calculate the depreciation. Okay?
Okay. And when you estimate the life, could that be, let's just say...
Oh, there's rules of thumb. Cars, 5 years. Software, 3 years. Office equipment, 7. Plant machinery, 10. Buildings, 40. Land never gets depreciated. Yep. And I used to think it was because it's always been here. All right. But theoretically, it's cost minus salvage value divided by life. Right? That's the calculation for straight line depreciation. So the question you got to ask yourself is, how long is this land going to be here? Forever. Well, you can't divide by infinity, so land is never depreciated. Okay. So you didn't know accountants had such lofty. All right. Okay. Now, what a classified balance sheet does is it breaks assets and liabilities into current and non-current. Okay? And before we leave, we're going to show why that's important. Okay? Current assets are assets that will be converted to cash or used within 1 year. And current liabilities are liabilities that have to be paid within 1 year. Okay? So, whoops. I don't know how that slide slipped in, but anyway, now, I just said that the net income that we calculate from the income statement flows into the statement of retained earnings, and then retained earnings flows to the balance sheet. All right? This is called articulation. And not that anybody I know that would publish financial statements that wouldn't balance, but it gives the reader, as the reader, you can see where income flows to the retained earnings statement, and the retained earnings then flows to the balance sheet, and the balance sheet balances. Okay. All right, now, you will see this when you do your projects. Every set of financial statements that are prepared has footnote disclosures. Some are required, some are there just to provide further explanation. Required footnotes the required footnotes are, first of all, you have to say, what is the organization? All right? The Utica Public Library is a not-for-profit organization that serves the community of Utica, and then the purpose of it is to provide educational and informational opportunities. You say, what is the organization? You describe how it, the form of business, corporation, not-for-profit. The second footnote that's required right below that would be, if I have choices to use certain accounting methods. In other words, I can use straight line depreciation, double declining balance. For inventory, I can use last in, first out, or first in, first out. For depreciation, I can use, did I already say this? I can use straight line or, yeah, I already said that. Okay, you have to tell the reader which method you've chosen. Okay, another required footnote is if I have long-term debt, I have to disclose the principal payments for each of the next 5 years and then a lump sum thereafter. If I have non-cancelable leases, I have to tell the reader what amounts am I obligated to pay in each of the next 5 years, and then a lump sum thereafter. If I have relationships with closely held businesses, I have to disclose that. So the companies you choose, their footnote disclosures are much more involved than, say, notes I would prepare for the type of companies I audit. See, they're saying that the notes are required either because it's a requirement, it's tradition, or the accountant's professional judgment. What we try to do is if there's an odd-looking item on the balance sheet or on the income statement, we try to provide an explanation. All right? The idea, we said on day one in this course, is the purpose of accounting is to provide information to external users. So we're trying to clarify, not confuse. All right. Another type of disclosure, if I'm involved in a lawsuit, and I may end up being liable to pay an amount, it just hasn't settled yet, I have to disclose that. I might show an item on my income statement about a discontinued activity, so I want to explain to the reader what that discontinued activity is. Okay. All right, now, I've talked about closing. The accounts that we close are called temporary accounts or nominal accounts. The accounts that get closed are the revenue accounts, the expense accounts, and dividends. The reason they're called temporary is because they have a life of one accounting year. All right, then we bring them back to zero and start all over again. Okay? One of the things you're going to be doing in Connect is closing entries. Okay? Permanent accounts are your balance sheet accounts. And the reason they're called permanent is because the ending balance of one year becomes the beginning balance of the next year. Okay? Now, the closing process, I'm not going to read all this, but basically what we're going to do is the revenue accounts are normal credits, so we're going to debit the revenue account to make it zero and credit something called the income summary. Now, in an automated system, you would simply tell the system that you want to close the year, and it automatically zeroes out revenue, zeroes out expenses, zeroes out dividends, and puts the net into retained earnings. But here we're going to, actually walk through the entries, and you're going to have to do this in Connect. All right? So this income summary is an extremely temporary account. It's only used at year end. And again, in an automated system, you wouldn't even see it. So, and then with the expenses, we're going to credit the expense and debit income summary, which will zero them out, and then the difference between revenue and expense gets closed to retained earnings. All right, now, all right, so here's an example, and this is what you're going to be doing in Connect. The total revenue off the trial balance was the 172 and the 3,000 as a credit balance. So I'm going to debit these and then credit income summary. All right, and then looking at it from a T account, the revenue accounts are now zero, and this income summary account as the total revenue. With expense accounts, I'm going to credit all the debit entries and then debit income summary. Okay? And here's another example. So all the expense accounts go to zero, and I debit income summary, and the 39,942 would be the number that I have on my income statement. Let me just say one more thing. When you prepare the statement of retained earnings, all right, that helps you prepare the balance sheet. But on your books and records, you still have revenue and expense in your revenue and expense accounts. It's the closing that gets the net income that you calculated actually into retained earnings. Okay? And then you close the income summary account by debiting the income summary and then crediting retained earnings. Now my retained earnings has been increased for the current year's income. All right, and then with dividends, you debit retained earnings and credit the dividends, and now the balance in my retained earnings account on my books will equal the retained earnings that I calculated on the statement of retained earnings. Okay, he keeps, okay, all right, okay, I'm going to blow, all right, this is another picture of it, and again, you have to do this in Connect, all right, now, the post-closing trial balance, what the benefit of it is, especially for startup companies, and I don't mean large publicly traded companies, but let's say 10 years from now you go off on your own, you start a company, you buy QuickBooks, and because you've had this course, you feel confident in setting up your accounts. Well, with these off-the-shelf software, you have to tell it, is cash an asset or is it an expense account? Or is it a liability? You have to tell the system. So in your first year of operation, the software is only going to do what you tell it. So the benefit of having the post-closing trial balance is to make sure that the only accounts with balances are your permanent accounts. Now, I've seen this happen. It doesn't happen a lot, but somebody will set up their chart of accounts and they will incorrectly call something an asset that's an expense. So you'll see, salaries expense up here, and obviously it's not right. So this allows you the opportunity to maybe fix a problem. Okay. All right, now, in Connect, you have to do some ratios. All right. The first ratio is the net income percentage, sometimes commonly referred to as profit margin. And you calculate that by taking net income divided by total revenue. Okay? Again, net income from the income statement divided by total revenue from the income statement. Return on equity is net income divided by average stockholders' equity. So in Connect, you're going to be given the beginning balance and the ending balance. You have to calculate the average. Okay? All right, any questions? We're probably getting low on time here. Now, we talked about the we talked about a classified balance sheet, all right? And what a classified balance sheet allows us to do is measure liquidity. Liquidity shows a company's ability to pay its current obligations, okay? So working capital is simply the absolute amount of current assets minus current liabilities. And you want to, and so a company has a healthy situation when its current assets are greater than the current liabilities. The idea is that current assets are available to pay your current liabilities. The current ratio is current assets divided by current liabilities. Ratios are helpful when you're comparing companies of different sizes. Okay? All right. Matt, we got some slides here that I didn't. I didn't think I made part of the slideshow. All right. Okay. All right. Okay. All right. Okay. We're done here. Any questions? Matt, what time is it? 6:40. Ooh, boy. Okay. All right. So again, the only thing you're required to do tonight is to take a trial balance, prepare the income statement, statement of retained earnings, and the balance sheet. Okay. Okay. Yes. Okay. All right. All right. Well, it looked like everybody understood what they had to do for the go live. And again, the Connect homework involved calculating ratios, doing closing entries, and then preparing financial statements. Now, if any of you have questions regarding the work, I keep getting questions about technology, and I'm afraid I can't really help you with the technology. But if it involves accounting, I can. So, and especially if you're getting an answer in Connect that you're quite sure is correct, but Connect is telling you it's wrong, I'll happily look into it. Okay, and if connector's wrong, I'll fix your grade. I can do that. It's good to be the king. All right, so next week we do not meet, but I have prepared a video, and again, it primarily deals with the preparation of the stockholders' equity portion of the balance sheet, and then answering questions on definitions. And I think I intentionally covered all the definitions tonight also. Now, I believe week 4 there's a case also. So in other words, we're not meeting next week, but there's a case. And again, the case also involves the preparation of the stockholders' equity portion of the balance sheet. So we won't meet for 2 weeks, but if you have questions regarding accounting, please feel free to contact me, and I'll get back to you. Okay, does anybody have any questions? Okay, then that's it for tonight. And thank you very much for attending.
Okay.